Welcome to Safe Simple Sound, Tax Edition. I'm Alex, your host, and I'm joined by Sam, our tax expert, and Taylor, who asks the questions you might have on your mind. Together, we break down complex tax topics into clear, actionable insights. We use AI-enhanced voices to deliver consistent, high-quality content while keeping our focus on what matters most, helping you understand your taxes. In each episode, I'll guide our discussion. Sam will provide expert analysis, and Taylor will make sure we explain everything in plain English. We're here to make taxes approachable, whether you're filing a basic return or dealing with more complex situations. But before we dive in, a quick note. This podcast is for entertainment only and does not constitute tax, financial, legal, or professional advice. Tax decisions should always consider your personal circumstances, filing status, and specific situation. All tax amounts, thresholds, and deduction values mentioned are examples only. Tax numbers change annually, and you must use the current official values from irs.gov when preparing your returns. Be sure to consult a qualified tax professional before making any tax-related decisions. If you would like personalized guidance, you can reach out to us at safesimplesound.com/contact. Let's get started. Today, we're diving deep into the sometimes daunting but ultimately essential world of tax preparation. This episode is based on a helpful step-by-step guide from IRS Document Publication 17, a perfect resource as we head into tax season. This guide provides a practical roadmap highlighting key aspects like gathering your essential tax documents, choosing the right filing method from DIY software to professional help, and understanding the crucial decision between taking the standard deduction or itemizing. At Safe Simple Sound, we believe in seizing financial control and understanding financial choices. And tax preparation is a prime example of putting those beliefs into action. Knowing the tax code and making informed decisions can significantly impact your financial well-being. So to navigate this topic effectively, we've structured today's episode into 4 key segments. First, we'll tackle gathering your tax records, exploring scenarios like the freelancer's dilemma with its multiple 1099s and the lost W-2 panic. Then we'll move on to choosing the right filing method, where we'll discuss the DIY or delegate decision and navigate the free file landscape. Our third segment will focus on the ever-important standard deduction versus itemizing choice, featuring scenarios like the charitable donor and the homeowner's dilemma. Finally, we'll wrap up with key tax changes and resources for 2024, examining scenarios relevant to the electric vehicle buyer and those planning home energy upgrades. Get ready for a practical and informative episode packed with real-life scenarios and actionable tips to help you navigate tax season with confidence. Let's dive in. Let's start with common tax preparation challenge, the freelancer's dilemma. Many of our listeners are freelancers, juggling multiple clients and income streams. This often means a pile of 1099 forms come January. How can freelancers effectively organize their income and expense records throughout the year, Sam? Because waiting until tax season can be a recipe for disaster, right?
Absolutely, Alex. Proactive organization is crucial for freelancers. Think of it like building a house. A solid foundation is essential. For freelancers, that foundation is a robust record-keeping system. It could be as simple as a dedicated spreadsheet or as sophisticated as accounting software. The key is to track every 1099 as it arrives and categorize each related expense.
So, if I'm a freelance writer, each article payment would be logged along with expenses like software subscriptions, internet costs, even a portion of my home office rent.
Exactly. And keeping digital copies of invoices and receipts is a lifesaver. You don't want to be scrambling for paper trails during tax season.
That's a great point, Sam. Now, what are some common pitfalls freelancers face when gathering tax documents, and how can they avoid them, Sam?
One common mistake is misclassifying expenses. For example, a new laptop might seem like a business expense, but if you also use it for personal reasons, you can only deduct the portion used for business. Another pitfall is neglecting to track mileage. If you're driving to meet clients, those miles are deductible.
The standard deduction versus itemizing, right? So as a freelancer, meticulous record keeping is essential to determine if itemizing is worthwhile.
Precisely, Taylor. You're catching on quickly. Sam, are there any other traps freelancers should be aware of?
One more is failing to account for quarterly estimated taxes. Unlike employees who have taxes withheld from each paycheck, freelancers are responsible for paying their taxes throughout the year. Not doing so can result in penalties come April.
So if I understand correctly, even if I'm diligently tracking income and expenses, I still need to be aware of my estimated tax obligations. Are there resources available to help calculate these payments?
Yes, the IRS website has helpful tools and publications, and tax software can often automate these calculations.
Let's recap. For our freelance listeners, consistent tracking of income and expenses is paramount. Categorize everything, keep digital copies, and be mindful of potential deductions like mileage and home office expenses. Don't forget about those quarterly estimated taxes. If you're a freelancer, take action today. Set up a dedicated system for tracking your income and expenses, whether it's accounting software or a simple spreadsheet. Your future self will thank you. Now let's switch gears to a common issue for employees, the dreaded lost W-2. Imagine it's just a few weeks before the tax deadline and you can't find that crucial piece of paper. This is the lost W-2 scenario. As a reminder, your W-2 shows your wages, salaries, and how much tax was withheld during the year. Essential info for filing your taxes. So Taylor, what steps should an employee take if they haven't received their W-2 by the deadline, which as a reminder from our reference article is January 31st?
That's a scary thought, Alex, especially so close to the deadline. I guess the first thing I'd do is check with my employer. Maybe it got lost in the mail or there was a problem with the address.
Absolutely, Taylor. Contacting your employer directly is the first and most important step. Most employers are happy to reissue a W-2. It's a pretty routine request.
Right? And Sam, what if the employer is unresponsive or say the company has gone out of business? How can someone obtain a copy of their W-2 from the IRS directly then?
If you've given your employer a reasonable amount of time to respond and still haven't received your W-2, you can contact the IRS directly. You'll need Form 4852, called the substitute for Form W-2. You'll estimate your wages and withheld taxes as accurately as possible. You'll also need your last pay stub to help with this.
So, if I understand correctly, Form 4852 is a backup plan, and it's important to try getting the W-2 from my employer first. This reminds me of when we talked about documenting freelancer income. Having multiple sources of information is key.
Exactly. It's easier and more accurate to get the official W-2. Form 4852 is for those situations where you've exhausted all other options.
To recap, the first step is to reach out to your employer. Give them some time. If that doesn't work, then you contact the IRS and use Form 4852. Now, Sam, is there anything else someone should do while waiting for the replacement W-2 or working through Form 4852 to avoid filing late?
Yes, a good idea is to file for an automatic 6-month extension using Form 4868. This gives you more time to get your W-2 without incurring penalties for late filing. But remember, this extension is for filing your return, not for paying any taxes owed. You still need to estimate your tax liability and pay what you think you owe by the original deadline.
That's a great point, Sam. I know people often get those two things confused. So even with the extension, it's crucial to pay what you estimate you owe on time to avoid penalties.
Exactly right, Taylor. It's always better to overestimate and get a refund than underestimate and face penalties. So, key takeaways here. If you've lost your W-2 or haven't received it, contact your employer immediately. If that fails, you have options. Use Form 4852 as a substitute and consider filing for an extension using Form 4868 to buy yourself more time. Remember to pay your estimated taxes by the original deadline, even if you file for an extension. Contact your employer immediately and request a new W-2. If unsuccessful, contact the IRS for assistance. Don't delay. Now, once you've gathered all your tax documents, including that sometimes elusive W-2, the next big decision is how to actually file. Should you do it yourself or hire a professional? We'll discuss that in our next segment. Imagine someone like Taylor here, who has a relatively straightforward tax situation. Maybe a W-2, some interest income, and the standard deduction. They're now faced with a decision: tackle their taxes themselves using DIY tax software or hire a tax professional. Sam, what factors should taxpayers in this situation consider?
A good starting point is comfort level. How comfortable are you navigating tax software, understanding tax forms, and interpreting IRS publications? If the thought of it makes you anxious, a professional can provide peace of mind.
That makes sense. I'm okay with technology, but taxes can seem like a whole different language sometimes. Like, even with software, how do I know I'm entering everything correctly and taking advantage of all the deductions I'm entitled to?
Exactly. Another factor is the complexity of your financial situation. If you have just a W-2 and take the standard deduction, DIY software might be perfect. But if you have multiple income streams, investments, rental properties, or itemized deductions, the complexity increases, and a professional might be a better choice.
To build on what Sam said, think of it like assembling furniture. A simple bookshelf, you can probably handle yourself. But a complex entertainment center with intricate instructions, you might want to call in the experts.
So, if I understand correctly, something like owning a small business or having significant investment income would likely push me toward a professional.
Precisely. Also, life changes like marriage, divorce, or inheriting property often introduce new tax implications that a professional can help you navigate. For example, the reference article mentions different filing statuses like married filing jointly or head of household. Choosing the correct status and understanding its implications can significantly impact your tax liability.
And remember our previous discussion on gathering records? The more complex your finances, the more complex your record keeping will be. A professional can help ensure you have everything in order.
This reminds me of what we discussed about freelancers. Even if their income isn't incredibly complex, they often have many different 1099s and deductible expenses to track. That sounds like a situation where professional help could be valuable, even if they don't own a business in the traditional sense.
Absolutely. Freelancers are a great example of where the record-keeping burden alone can make professional assistance worthwhile. They often benefit from expert advice on maximizing deductions too, which can more than offset the cost of hiring a professional.
So, to recap, when deciding between DIY or delegating, consider your comfort level with tax software and the complexity of your finances. DIY is great for simple situations, but complexity warrants professional help. Think about life changes, multiple income streams, and substantial deductions.
It definitely seems like weighing the cost of a professional against the potential for errors and missed deductions is key.
Exactly. Take a moment to consider your own situation. Assess your comfort level with tax software and the complexity of your finances. Consider the potential cost savings of DIY versus the benefits of expert advice. That's your call to action for this section. Now we're going to dive into a really helpful resource for many taxpayers, especially those with lower incomes, the Free File program. This scenario features Swift, who is exploring her free file options. Swift is single and earned $60,000 last year. She's comfortable with technology, but a bit overwhelmed by the different free file options. So let's start with the basics. Sam, who qualifies for the IRS Free File program, and what are the different options available?
The IRS Free File program is designed for taxpayers whose adjusted gross income is below a certain threshold. For the 2024 tax year, it's $79,000. There are two main pathways within Free File. First, there's IRS Direct File, a new offering that lets you file directly through the IRS website. Second are the guided tax software options offered by various partner companies. These programs offer different features, levels of guidance, and sometimes state tax filing options, even if the federal filing is free.
So, if I make less than $79,000, I could potentially file my federal taxes for free. That sounds amazing. But what's the difference between filing directly through the IRS and using one of the guided software options?
A great question, Taylor. IRS Direct File provides a straightforward way to file if your tax situation is relatively simple. It's a bare-bones, no-frills option, designed for those who don't need a lot of hand-holding. The guided tax software, on the other hand, offers more features like importing W-2 information, error checking, and contextual help with tax laws. They often have a more user-friendly interface, especially if your situation involves credits or deductions.
It's like choosing between a basic calculator and a scientific calculator, Taylor. One gets the job done for simple calculations, while the other provides more functions for complex situations.
Okay, that makes sense. So if I'm comfortable doing my own taxes but want some extra guidance, the guided software is probably a better fit.
Exactly. Plus, some of the guided software packages might also offer free state tax filing, which isn't always included with IRS Direct File. You'd have to check the specific details of each offer.
Sam, what are some of the limitations of using IRS Direct File versus the guided software?
IRS Direct File, while free and simple, might not be suitable for everyone. It doesn't support every tax form or schedule. For example, if you have self-employment income or itemized deductions, you might find it limiting. The guided software options generally offer support for a broader range of tax situations. Also, if you're not very comfortable with tax terms or the filing process, the guided options provide step-by-step guidance and explanations.
So if I'm itemizing, which sounds more complex, I'd probably want the help of guided software, right?
Precisely. If your situation is more involved, you'll likely benefit from the extra support and features of guided software.
So, to recap, if you're eligible, Free File provides two primary options: IRS Direct File, which is simple and direct for basic tax returns, and guided tax software, offering more support and features for potentially more complex situations. We highly encourage you to check out irs.gov/freefile to determine your eligibility and explore the available options. It's a valuable resource that could save you time and money. Now let's move on to a crucial decision everyone faces when filing: choosing between the standard deduction and itemizing. This can have a big impact on how much you owe, especially in certain scenarios. In this scenario, we'll meet a hypothetical taxpayer who's made significant charitable contributions throughout the year. This raises a key question. Is taking the standard deduction still the best route, or does it make more sense to itemize? Sam, Taylor, let's dive in. Under what circumstances does itemizing become more beneficial than taking the standard deduction?
Simply put, Alex, itemizing becomes advantageous when the total of your eligible deductions exceeds the standard deduction amount for your filing status. The reference article we have lists the 2024 standard deduction amounts, which is a great starting point. For example, it's $14,600 for single filers and $29,200 for married couples filing jointly.
So if I understand correctly, if I'm single and donate $15,000 to charity, I should definitely itemize, since that's more than the $14,600 standard deduction, right?
That's a good starting point, Taylor, but it's not quite that simple. Charitable contributions are just one type of itemized deduction. Others include certain medical expenses, mortgage interest, state and local taxes, and a few more. You need to add up all your potential itemized deductions to compare them against the standard deduction.
That's a great clarification, Sam. It's like a seesaw. You're trying to tip the scales in your favor. On one side is the standard deduction, a set amount. On the other side are your itemized deductions. Whichever side is heavier determines which option is better.
Okay, so even if my charitable donations alone don't exceed the standard deduction, other eligible expenses could tip the balance towards itemizing. This brings me to Alex's second question. How do we accurately track and document these deductible expenses? I imagine good record keeping is essential.
Absolutely. The Gather Your Records section of our reference article emphasizes this. You'll need documentation for everything you claim. Think receipts for charitable donations, medical bills, and mortgage interest statements. Form 1081.
That's right. Imagine trying to piece together a puzzle without all the pieces. It's frustrating, and you won't get the full picture. Proper documentation is your complete puzzle, showing the IRS you have the proof to support your deductions.
This reminds me of what we discussed about freelancers needing to keep meticulous records of their income and expenses. This applies to everyone, regardless of how they earn their income.
Precisely. And speaking of different scenarios, some deductions have limitations. For instance, you can only deduct medical expenses exceeding 7.5% of your adjusted gross income AGI. So, if your AGI is $100,000, you can only deduct the portion of medical expenses exceeding $7,500.
Excellent point, Sam. These nuances are crucial. It's important to dig deeper than just the surface level. Now, before we move on, let's recap. Itemizing is beneficial when the sum of your deductions, charitable contributions, eligible medical expenses, certain state and local taxes, and other qualifying expenses is greater than your standard deduction. Accurate record keeping is essential to support your claims. Speaking of other qualifying expenses, let's explore another common itemized deduction: mortgage interest. In our next scenario, the homeowner's dilemma, we'll look at how this factors into the standard deduction versus itemizing decision, especially with fluctuating interest rates. In the meantime, listeners, remember, keep meticulous records of all your potentially deductible expenses throughout the year. It's never too early to start. Don't wait until tax season to scramble, and consult a tax professional or utilize reliable tax software to help determine the best strategy for your specific situation. So, Taylor, we just explored how charitable donations can sway the decision of whether to itemize. Now let's shift gears to another common itemization consideration: homeownership. In this scenario, we'll call it the homeowner's dilemma. We'll look at how owning a home, specifically the mortgage interest and property taxes you pay, can play a big role in your tax strategy. Imagine you're a homeowner and you're trying to decide the best way to file your taxes. You know you can take the standard deduction, which is a fixed amount based on your filing status. But you also know you can itemize, potentially deducting things like mortgage interest and property taxes. The question is, which is better for you? Sam, let's start with this. How do changes in mortgage interest rates and property taxes impact the decision to itemize?
Great question, Alex. The higher your mortgage interest and property taxes, the more likely itemizing will be advantageous. Think of it like a seesaw. On one side, you have the standard deduction, a fixed amount. On the other side, you have your itemized deductions. As interest rates rise or your property taxes increase, that itemized deduction side of the seesaw gets heavier, potentially tipping the balance in favor of itemizing. Conversely, lower interest rates or property taxes lighten that side, making the standard deduction more attractive.
So if I understand correctly, if my mortgage interest and property taxes combined are less than the standard deduction, I'm probably better off taking the standard deduction.
Exactly. It's all about which amount is greater.
And that brings us to my second question. What other factors besides mortgage interest and property taxes might influence this decision?
Several things, Taylor. Medical expenses exceeding 7.5% of your adjusted gross income can be itemized. Also, state and local taxes, SALT, including income or sales taxes, as well as any personal property taxes. Charitable contributions, like we just discussed, also play a role. Essentially, any deduction you can claim on Schedule A.
This reminds me of what we discussed about gathering records. It sounds like keeping good records of all potential deductions is crucial. If you don't have the documentation, you can't claim the deduction.
Absolutely. Those W-2s, 1099s, and supporting documents mentioned in that helpful guide are essential.
Let's say, Taylor, you live in a high-tax state and had some significant medical expenses this year. Even if your mortgage interest is relatively low, those additional deductions could push you over the threshold where itemizing becomes more beneficial.
That makes sense. So it's not just about one big deduction, but the combined effect of all possible itemized deductions. It's like building a puzzle. Each deduction is a piece, and you need enough pieces to complete the picture, or in this case, surpass the standard deduction.
A perfect analogy, Taylor.
So to recap, homeowners face a crucial decision: itemize or take the standard deduction. Mortgage interest and property taxes play a significant role, but other factors, including medical expenses, state and local taxes, and charitable contributions, can also tip the scales. The key is to calculate your potential itemized deductions and compare that total to the standard deduction for your filing status. If itemizing seems complex, consider seeking advice from a qualified tax professional. They can help you navigate the process and ensure you're making the best decision for your financial situation. So, Taylor, I think we've got a good grasp now on how homeowners can navigate the standard deduction versus itemizing, especially considering factors like mortgage interest and property taxes. Now, let's shift gears a bit and talk about another exciting area where tax incentives can really make a difference: electric vehicles. In this scenario, we're going to step into the shoes of someone considering buying an electric vehicle. Let's call them Taylor. and they want to understand how the updated clean vehicle credit works. This is something a lot of people are thinking about, especially with rising gas prices and the growing focus on sustainability. Sam, kicking things off, can you tell us what are the new eligibility requirements for the clean vehicle credit in 2024?
Absolutely, Alex. The Clean Vehicle Credit has undergone some significant changes. For 2024, there are requirements related to the vehicle's final assembly location, battery component sourcing, and the buyer's modified adjusted gross income MAGI. There are also different credit amounts depending on whether the vehicle is new or used.
Magi? That sounds familiar. Is that similar to the AGI we talked about when discussing the free file program?
Yes, Taylor, it's related. MAGI is your adjusted gross income with certain deductions added back. The specific MAGI limits for the Clean Vehicle Credit will depend on your filing status.
Good catch, Taylor. It's always helpful to connect these concepts back to what we've already covered. Sam, could you maybe give us an example of how these requirements might work in practice?
Sure. Let's say you're looking at a new electric SUV. To qualify for the full credit, the final assembly needs to have taken place in North America. There are also requirements about a percentage of the battery components being manufactured or assembled in North America. And finally, your MAGI needs to fall below a certain threshold.
So, if I'm single and make over a certain amount, I might not be eligible at all, or I might get a smaller credit.
Exactly. The credit is designed to make EVs more accessible to a wider range of consumers.
That's really important to understand. Now, our hypothetical Taylor is diligently researching before heading to the dealership. Where can consumers find reliable information on qualifying vehicles and credit amounts, Sam?
The best place to get the most up-to-date and accurate information is directly from the source, irs.gov. They have detailed information on the Clean Vehicle Credit, including lists of qualifying vehicles and the specific credit amounts. You can also find this information in IRS Publication 17.
That makes sense. So if I understand correctly, I should check the IRS website first to make sure the car I'm interested in actually qualifies, and that I meet the income requirements. It's not just about whether the car is electric.
You've got it, Taylor. That's a crucial point. So, let's recap. The Clean Vehicle Credit offers a significant incentive for purchasing an electric vehicle, but there are specific requirements regarding final assembly, battery components, and income limits. To ensure you're getting the right information, always check irs.gov or consult with a qualified tax advisor. Do your homework before heading to the dealership to avoid any surprises. So, Taylor, after navigating the ins and outs of the Clean Vehicle Credit, I bet some of our listeners are thinking about other ways to save money and be more environmentally conscious. Let's shift gears now from our cars to our homes and talk about tax credits for energy-efficient home improvements. This is our scenario, the home energy upgrade. Imagine you're a homeowner wanting to make your house more energy efficient. Maybe you're thinking about installing solar panels, upgrading your insulation, or switching to a more energy-efficient heating system. Luckily, there are often tax credits available to help offset the costs of these upgrades. Sam, let's start with the basics. What types of energy-efficient home improvements actually qualify for these tax credits?
Several upgrades qualify, Alex. The big ones are solar electric panels, solar water heaters, fuel cells, small wind turbines, and geothermal heat pumps. You can also get credits for things like insulation, energy-efficient windows, doors, and air conditioners, but these typically have different credit limits and requirements.
So, if I understand correctly, bigger projects like solar panels have their own set of credits, while smaller things like insulation fall under a different category.
Exactly. Think of it as tiered incentives. The government wants to encourage both big and small steps towards energy efficiency.
Great point, Sam. Now, how do homeowners actually navigate the process of claiming these credits? What paperwork do they need?
First, it's crucial to ensure the improvements meet specific energy efficiency standards. The Energy Star label is a good indicator, but always double-check the IRS guidelines for the specific credit you're aiming for. Keep all invoices and receipts detailing the work done and the equipment installed. When tax time rolls around, you'll use Form 5695 Residential Energy Credits to claim the credit. This form will require information about the improvements, the contractor, and the cost.
This reminds me of what we discussed earlier about keeping good records. It's important to have those receipts organized. Let's say I install new energy-efficient windows. What kind of documentation would I need specifically for that?
You'd need receipts showing the purchase and installation costs of the windows, the manufacturer certification stating they meet Energy Star requirements or other qualifying standards, and ideally, a copy of the manufacturer's certification statement, which often comes with the windows.
That's helpful, Sam. So, keep all those documents with your tax records. Remember, we talked earlier about how long to keep different types of records, and tax records in general should be kept for at least 3 years.
So if I'm aiming to upgrade my home's insulation and maybe install solar panels next year, I should start a file now to keep all the paperwork together as I go, right?
Absolutely, Taylor. That's proactive and precisely the right approach.
Let's recap. We learned about different types of energy efficient home improvements that qualify for tax credits, the importance of meeting energy efficiency standards like those set by Energy Star, the necessity of detailed documentation, and the use of Form 5695. Now, for our listeners, your call to action is this: research the available energy efficiency tax credits thoroughly. Consult with a qualified contractor to ensure the improvements meet the requirements, and a tax advisor to understand how to maximize your savings. Don't leave money on the table. And that wraps up our deep dive into tax preparation here on Safe, Simple, Sound. We covered a lot of ground today, from gathering those crucial W-2s and 1099s, as discussed in the IRS Publication 17, to strategically choosing your filing method and deciding between the standard deduction and itemizing. Just like the article highlighted, being prepared and informed is key to a smooth tax season. I think the scenarios we discussed, particularly the freelancer's dilemma and the homeowner's dilemma, really brought to light the nuances of tax preparation and how important it is to understand your specific financial situation. Remember, seizing financial control means taking the time to understand these details so you can make the most informed choices for your future. Thank you for joining me today on Safe, Simple, Sound Tax Edition. Check out the show notes for all mentioned resources, including IRS sources and helpful tools. If you found value in this episode, please leave a review and share it with someone looking to better understand their financial choices. This is Alex, wishing you safe, simple, and sound financial journeys.